Today is Global Minimum Tax Part 5. Disclaimer: the following information is intended only to be a guide. It must not be relied on in or applied to specific situations without seeking proper professional advice. This material is prepared by appropriately adapting the content provided on the Global Minimum Tax Portal produced by the National Tax Service of Korea in 2025. Today I'm going to talk about the flow chart for top-up tax calculation. The step 1, the first step is I will explain the step 6. The step 1 is the identification of a multinational enterprise group subject to the global minimum tax. This needs to be done by UP. And there are two types of requirement. Requirement 1 and requirement 2. Requirement 1 is the group. This should be group. This means that group must have one or more enterprise or permanent establishment located in at least one foreign jurisdiction. So if a company has only one country, company A, this cannot constitute a group. So the global minimum tax will not be applied to this kind of company. Should be group. Requirement 2 is at least 2 of the 4 preceding fiscal years. The consolidated revenue of the group must be not less than 750 million euro for 2 of 4 fiscal years. So, for instance, this year is, for instance, fiscal year 25, then 24, 23, 22 and 21, and if this is 7.2, 720 million, 720 million, 760 million, 700 million, 800 million. In this case, the preceding 4 year, 21, 22, 23, 24, this year and this year, 2 years exceeding 750 million threshold. So this group will be subject to global minimum tax. This is step 1, the identification and definition of the company group to be applied to the global minimum tax. Step 2 is the allocation of income to constituent entity by jurisdiction. I think that this also should be done by UPE, ultimate parent entity. All constituent entities and permanent establishment within the group that recognize accounting in net income or loss are identified. So there are, for example, 50 groups, 50 companies in the group. Then the accounting income of each constituent company should be identified. The accounting net income of each constituent entity is then determined in accordance with the accounting standard used in preparing the consolidated financial statement of the ultimate parent entity. And what is also important is the unification of the method. This means that each company can apply their own accounting principles for their financial statement and financial tax return. But for GMT purpose, global minimum tax purposes, all the accounting principles should be unified into one accounting principle, which is used by parent entity. So this needs the unification of the accounting principle from each constituent entity. This is step 2. So step 1 was identification. Step 1 was identification of group, which should be subject to GMT. Step 2 is the identification of accounting income in financial statement using the only one accounting principle, which is used by the ultimate parent entity. This is step 2. And step 3 is calculation of global income. The expression global is usually abbreviation of global anti-base erosion. This is the foundation of the GMT, global minimum tax. So calculation of global income is step 3 for each constituent entity. To determine the global income, the accounting net income should be adjusted by applying the below adjustment items. So there are two kinds of income. One is financial income in the P&L of that company, and there is a global income, which is used for computation of GMT. So between the two, this is A, this is B. Between A and B, there should be adjustment. There should be adjustment. So this means that the normal corporation tax for the current year will be computed based on this financial income, income A. But GMT, global minimum tax, will be computed based on income B, which is global income after adjustment of various items. This is mentioned in the Article 66 of the AITA, Adjustment of International Tax Act. The global income for each business year shall be calculated by reflecting the adjustment prescribed by presidential decree, such as addition of net tax expense and the exclusion of dividend from the shareholder, blah blah. So there are 19 items are illustrated in the presidential decree. So this is so huge and so complicated. So I want to mention briefly about some items. Item number 1, the addition of net tax expense. Item 2 is deduction of dividend income. Item 3 is addition of policy disallowed expense. Item 4 is adjustment of equity gain or loss. Item 5 is adjustment of revaluation gain or loss. And item 6 is adjustment of asymmetric gains or loss on foreign exchange. And item 7 is adjustment of pension profit and loss. Item 8 is adjustment of stock-based compensation expense. And item 9 is adjustment of expenses for a group internal financial agreement, blah blah. So there are all 19 items are mentioned in the previous decree, but I think that most of the items is not relevant to normal companies, normal business companies doing business in Korea or in the world. So this adjustment is important, but this adjustment should be clearly should be thoroughly investigated, and then if there is no relation with the group, then it should be abolished. Step 4, calculation of adjusted taxes. So in step 3, we compute global income. Okay? And in step 4, we compute adjusted tax. Similar to S3, global income. In global income, we compute the financial income, income A, and global income, income B. Between A and B, there is an adjustment. So we call the income after adjustment, we call it as global income for computation of GMT. And S4, this is S3, step 3. And step 4, the same situation. This is the tax expense in the P&L. And this is adjusted tax for computation of GMT. So between A tax and B tax, there should be some adjustment. So after doing some kind of adjustment, the group should compute the adjusted tax, which will be used for computation of GMT, global minimum tax. Step 4, calculation of adjusted tax. To determine the relevant covered tax, the current corporate tax expense reported in each constituent entity's financial statement shall be adjusted by applying the following adjustment items, which is mentioned in the Presidential Decree. Presidential Decree, Article 110, there are many items to be adjusted from the normal tax expenses, tax A. That is, some items are additional item. Addition, number 1 is the amount of covered tax which are appropriated as expenses in the calculation of pre-tax profit in accounting. And number B is the amount of covered tax paid in the relevant fiscal year, which is related to uncertain tax treatment item, which has been treated as deducted in the previous fiscal year. And there are also some deduction item. Deduction item is current corporate tax expense for income excluded from the calculation of global income or loss pursuant to the Article 66 of the Act, and some other items. There are 6 items mentioned in this law. Okay. So after adjusting all this kind of doing the adjustment, the adjusted tax will be computed. So now it is very important to compute step 3, the global income, and step 4, the adjusted tax. And number 5 is the computation of the effective tax rate and the top-up tax. The formula is C equal B divided by A. A means global income of a constituent company. B is the adjusted income, adjusted tax. this gross income will be computed at step 3, and this adjusted tax will be computed at step 4. Okay, so and C is effective tax rate. Of a constituent entity. Okay, so we compute A in the process of step 3, and we compute B in the process of step 4. Step 3 and step 4 we compute. You compute them after applying various kinds of adjustments from the income or tax in the financial statement. And E equal A minus D. A equal gross income. D means substance-based income exclusion. Substance-based income exclusion. Some expenses are excluded from the computation of GMT as a deduction, like a deduction. We'll explain this one D later. And E equal jurisdictional excess profit. This means excess profit. So gross income minus some exclusion deduction is excess profit. Okay. And F equal 15% minus C. C is effective tax rate. Effective tax rate is computed divide step 4 divided by step 3. Okay. So 50% is global minimum tax already determined, and C is the effective tax rate. So F equal jurisdictional top-up tax percentage. Jurisdictional top-up tax percentage. Okay. So for instance, if the effective tax rate equals 10%, then 15% minus 10% equal 5%. 5% will be the top-up tax percentage. Okay. And G equal E, and G equal E multiplied by F. E equal excess profit. F equal this top-up tax percentage. Okay. So G is GMT, global minimum tax. So global minimum tax is computed by multiplying the excess profit by the top-up tax percentage. And finally, J equal G plus H minus I. J means the actual payable or net payable. H equal additional additional top-up tax, if any. In some cases, the additional top-up tax can be computed, but this is rare. And I equal the QDMTT. So if the country apply the QDMTT, then QDMTT should be deducted from the taxable amount. So J is GMT tax, which is computed by multiplying the excess profit by the top-up tax percentage, and plus some additional top-up tax, which is not very frequent, and minus QDMTT. In Korea, we do not apply QDMTT, so in Korea this will be 0. This is step 5. In step 5, we compute the effective tax rate, and the top-up tax. And finally, step 6. Step 6 is the comprehensive explanation of all these processes. Step 6 equals calculation of effective tax rate. This is the repeat of the principle. Calculation of effective tax rate. Effective tax rate. The effective tax rate is calculated by dividing the total adjusted tax of each constituent entity located in the jurisdiction by the total net global income of each constituent entity located in the jurisdiction. If the adjusted tax computed by step 4 and global income computed by step 3. If adjusted income is 0 or negative, then effective tax rate will be 0. And if global income equals 0 or negative, then the effective tax rate will also be 0. And we mentioned that the global income minus substance-based exclusion equals excess profit. Okay, so this substance-based income exclusion, to calculate the excess profit, specify the percentage of the eligible payroll cost and eligible tangible asset for each year is deducted from the net global income. And the rate is, for instance, payroll cost in 24 and in 33. In 24, this is 9.8%, and in 33, 5%. This will be gradually diminished. And also the tangible assets, 7.8% to 5%. So if the company's annual payroll cost is 1,000, then the 9.8%, 98 will be deducted as a deduction. If the tangible asset amount is 5,000, then the 7.8% of 5,000, for example, and 370 or so will be deducted from global income, like a deductible expense. And this is finally the total arrangement of this rule. Okay. I have to repeat the 3 basic rules of GMT. The number 1 is QDMTT. Q, qualified domestic minimum top-up tax. Number 2 is IIR. Number 3 is UTPR. This will be applied in sequence. As a diagram, this is UPE, and and we have intermediate parent entity and constituent entity. There are two, for example, to make it simple, constituent entity 1, constituent entity 2. This is in low tax country. This is normal. Okay? Normal means 15% or more. Yeah. Okay, QDMTT. QDMTT is applied directly to this low tax country which is adopting QDMTT. For instance, if South Korea adopt the QDMTT and South Korea's low tax rate, the tax rate is less than 50%, then Korea should apply the QDMTT rule in the first place. I have some, for Indonesia, I think that they adopt the QDMTT already. So in that case, if Indonesia's tax rate is, if Indonesia's tax rate is less than 15%, then that Indonesia, the global subsidiary located in Indonesia should pay the QDMTT in Indonesia. And this is number one. This is number one QDMTT. Number two is IIR, Income Inclusion Rule. And this will be applied to UP or IPE. In countries like Korea where the QDMTT has not yet been enacted, if the effective tax rate of Korea entity is below 15%, Korea do not have QDMTT. So instead of Korea, the UP or IPE is liable to pay the top-up tax. The top-up tax attributable to Korea entity must be borne by the UP or IP, provided that the UP or IP is located in a jurisdiction that applies the GMT. Yeah, of course, if the UP or IP does not adopt the GMT or IIR, then the UP or IP cannot tax the GMT internally in their country. Of course, if the jurisdiction where the UP is located apply the GMT, the UP is naturally subject to the top-up tax in the first place. However, if the jurisdiction of the UP does not apply the GMT while the jurisdiction of IPE does, then the top-up tax is imposed on the IPE instead. This is IIR. And number three, UTPR. This mechanism allocates the remaining top-up tax if it is not fully resolved through step 1 and step 2. This is some complementary method. So if the top-up tax cannot be fully solved by step 1 QDMTT, step 2 IIR, then final result will be UTPR. The mechanism allocates the remaining top-up tax if it is not fully resolved through step 1 and step 2 to all constituent entity, including parent entity, that are located in jurisdiction applying the UTPR based on a prescribed allocation formula. The allocation has some allocation formula, but I will explain later. Anyway, if the top-up tax rate is, for example, 7%, for example, and then this 7% is not resolved through step 1 and step 2, then finally the UTPR method should be applied to solve this remaining top-up tax. Okay, so QDMTT. So detailed explanation of each step. QDMTT qualified domestic minimum top-up tax if the jurisdiction where the low tax constituent entity is located has implemented the QDMTT, the top-up tax is paid to that jurisdiction. As I mentioned before, but if the country applied QDMTT, the first step is, the first priority is applying QDMTT. Number 2, IIR. IIR means income inclusion rule applied in advance to the UTPR. So this has a sequence, number 1, number 2, number 3, hierarchy. The parent entity that owns the low tax constituent entity pay the top-up tax under IIR. When the UP country does not enact GMT, the top-up tax may be imposed on IPE, intermediate parent entity. The formula is, for instance, the parent entity and constituent entity that the relationship is 100%, then the parent entity will own fully. But if parent entity ratio, ownership ratio is 70% and 30% is owned by other constitution, other company, other group, then the parent entity's portion is 70%. So the parent entity will liable to only 70%. So top-up tax allocated to the parent entity is A multiplied by 1 minus B. A equal globe income after substance-based exclusion, multiplied by 1 minus ownership ratio of ultimate parent entity. So if so I'm sorry, the ownership of ratio owned by other than UP. Other than UP. So if UP has fully 100%, then other than UP is 0. So the global income is fully applied. But if the other owner ratio is 30%, then 1 minus 30% is 70%. So the 70% will be borne by UP. Number 3, UTPR. Under tax payment rule, apply if the income inclusion rule does not fully allocate the top-up tax. When the QDMTT and IIR does not fully allocate the required top-up tax, the final method is UTPR. When the QDMTT and IIR does not fully allocate the required top-up tax, the residual top-up tax is allocated to constituent entity located in jurisdiction applying the UTPR, including parent entity. The ratio is, the applying ratio is A divided by B plus C divided by D 50%. Okay? A is number of employee of a certain specific constituent entity. B is number of employee of whole group. C equals total net book value of tangible asset of that CE. D is the book value of tangible asset of the group. Okay? So A divided by B, C divided by D plus N multiplied by 50%. This will be the allocation ratio. I think this is very rational. Today I'm simply explain about the computation of effective tax rate and computation of top-up tax, and also I emphasize the hierarchy of the GMT application. The first is QMBTT, second IIR, finally UTPR. Thank you very much for hearing my lecture.